Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is January 17th, 2025. S&P 500 currently sitting at 6,007. I'm David Zarling. I'm here with Ian, Profitable College Sports McMillan.
They need to be.
They need to be, right? Why run a college sports program negative? Doesn't seem to make sense.
For the sake of fairness, I guess.
Fairness, because life is fair.
Markets are fair.
Yeah, right. Markets are
fair. Very fair.
Mm-hmm.
We're back above 6,000. That's not where we were last Friday.
No, I thought you guys
were agreeing this week.
Mm-hmm. Well, and if we were to close like this, and we have a few hours to go, we'd have a bullish engulfing candle on the S&P on a weekly basis. Now, what that means is the opening price and the closing price exceed the price opening and close of last week. And all this is happening with breadth, participation of stocks at extremes. We don't have, going into today, we didn't have a single sector of the 11 sectors above a 50-day moving average.
Wow.
You had bullish percent in O's down in the 40s. And as you highlighted before we hopped on here, not a lot of damage done to the broad index in that scenario.
There is not. I mean, I'd say markets have been weak for about a month now.
Mm-hmm.
Middle of December. I'm sure you can find stocks or sub-industries that have been weaker or stronger. But yeah, for broad market, about a month, maybe 5 weeks, but big bounce back this week so far. What stood out to you then, Dave?
Over the past week, I think what you highlighted there is just, yes, we saw weak breadth underneath the surface. And I fully realize that the S&P doesn't represent the whole market. And yes, it's a consideration when all the sectors were below a 50-day moving average. But I think in context, it's important to remember what's the direction of that 50-day moving average. And what's the direction of the 200 days? For many sectors, it's up. For some sectors, it's flat. So yeah, in some cases like energy, have you been hanging around and not doing much for quite a bit? I think it's fair to say that energy really hasn't done much since June of 2022, but here energy's back above a 200-day, a 50-day, and by all intents and purposes, I mean, it's the best performing sector year to date. And I know that we want to be paying close attention to January performance for the market as a whole. And right now, S&P's close to for January. That, so goes January, so goes the year, is the seasonality saying. And so we've got a few days left. We've got a 4-day trading week next week with Martin Luther King Day on Monday. Also happens to be an inauguration, which I just heard they're moving indoors because it's going to be so cold. I wonder how many times.
Yeah, I saw it snowing in DC.
Really?
Yeah, because I read a story last night. A car went into the river.
Into the Potomac.
And then all the videos had snow.
Wow.
And it's cold there.
I know here we're supposed to get single digits with -10, -20 wind chill next week. Yeah. Your favorite type of weather?
Not what they have in Antigua.
No. Antigua's beautiful, beautiful culture. All their housing there is super colorful. People take pride in their homes, and they may not be the biggest homes you've ever seen, but
they take care of them.
And one side of the island has rainforest. Another side is arid, like California. I mean, it's a pretty diverse island.
It's pretty cool.
Yeah, it's a good trip. Good to relax. Good to take a chance to mourn dad and rethink some things. Reset. So I appreciate you guys covering for you, and Kevin did a good job last week, kind of highlighting where some important levels were for the market. And so far we responded to those, I would say.
Yeah, and we got a little, we talked about last Friday, we were below that 58.50 barely. So that was kind of your first chink in the armor. But Monday, we gapped down. Most things closed quite a bit higher, back above there. So far, just another blip on the radar, and a pretty strong uptrend.
Yeah, it's a strong uptrend, broadly speaking, and even sector speaking, just because you do have rising 50 days and 200-day moving averages. I'll go back to, yes, there was weakness underneath the surface, but now this feels like another table is set moment in the market where I don't want to call it to the extreme similarity to late October, early November of 2023, but what we don't have is extreme breadth the other way, extreme positive breadth. And that's typically when you see correlations go to 1 and corrections start. We're actually starting from a new base. It's almost like you had a reset in breadth. And, we have price levels that you guys highlighted last week that we can watch. There's always going to be a market with red flags. I know we talked before hopping on here about Apple. Apple would be one of those where it's worth paying attention to.
Apple's, I don't know what we're doing over there, but needs to get back above 237.
And you have this scenario where, in addition to breadth resetting, you have credit spreads actually cooling off. So credit is not tightening, which is another way to say that money is flowing freely. You have a relationship like junk bonds versus intermediate treasuries continue to consolidate and move higher. Another indication of risk on positive money flow. And then you have the biggest inflow since April of 2020 into money market funds.
That was going to be my next comment. Yeah. I mean, you want to talk about, we're on a six. Okay. So clearly you hear March, April 2020, big influx into money market funds. Okay, that makes sense. 6% drawdown after a 28% rally. Well, I mean, that was just year to date. So if you actually go back to November, I mean, it was strong. And then we had the same rush to cash. And I get that part of that is because there's more money in the system, right? Like I wouldn't compare money market flows in 2024 to 1970.
Right.
Because there's like way more just money out there that would be naturally sitting in cash no matter what. But yeah, to go back to something, and I would say in the grand scheme of markets, COVID pretty near term, 40 years ago, 4.5 years ago. So to see that behavior again, I do find that fascinating.
Does that reek of optimism?
No. So we still have clearly not. If we haven't hit optimism, we haven't hit euphoria.
Right. So we're still living in skepticism.
And then you get these overnight moves like we had Wednesday. I guess it was, I don't know, some government, CPI or something. Whatever, these things they release at 8:30 in the morning and 8:30 Eastern, earlier for you. Gets features in a tizzy, and
I don't know if you know that, but I don't get up for the CPI.
Continuation of the trend we've been in. Now, we're not to new highs yet. Some things are. Some things are to new highs.
But you highlighted before that, I mean, it's really interesting to see there's a gap up overnight from the election.
Yeah.
And this corrective move since mid-December filled that gap.
Yeah, S&P cash filled that perfectly and immediately bounced, like intraday bounced.
Right. And there's important levels there, whether you're looking at volume profiles and points of control or volume weighted average price. The auction process is a beautiful thing to watch, right? Because what really is happening when price is falling, right? Sellers are outpacing buyers, but it's all about finding where the buyers are willing to step in. And so far, the buyers were willing to step in at 57.80 cash on the S&P. And I would argue that I bet that data point on 11 sectors being below a 50-day is going to dramatically change. You know, when I look quickly, financials back above a 50-day, communication services above a 50-day, industrials above a 50-day, materials are not.
RSP is not right there. So equal weight S&P is there.
Utilities back above a 50-day. Discretionary never got to a 50-day. XLK back above a 50-day. Energy back above a 50-day. So, we have an environment where now it's almost 8 out of 11 sectors back above a 50-day moving average.
Well, better panic buy.
Right. And that's what happens is, we also saw, bar charts on Twitter or X posted that hedge funds reduce their leverage at the fastest pace in more than 2.5 years. So there's a pretty big deleveraging that just happened. You combine that with the flight to money market, most we've seen since the COVID crash, it reeks of another setup that people might get caught again. And I'll say, I don't see a lot of BTFD posting out there.
No. Crypto community is pretty hype.
Right.
Big, and they've got some silly, they got their typical silliness going on, fart coin and whatever. This stuff ain't these people.
HODL and diamond hands. But I mean, isn't it telling?
But Bitcoin back all-time highs almost.
Yeah. And isn't that telling that Bitcoin did that, made this move with the dollar stronger? And it held up really well versus the broad market. And so now you have a scenario on your hands where is Bitcoin about to launch to its next leg higher, and people are going to be caught with their swimsuit off as the tide goes out and leaves it behind. Time will tell. And we have our price levels that we can use, whether it's
the relative chart looks really good.
Mm-hmm. Comparing
Bitcoin to S&P looks really good, right? Because that's a thing, right? It's Bitcoin can do great. S&P's been in an uptrend for, 15 months at this point. So yeah, getting above relativized, consolidated nicely. I mean, I'd definitely rather anything than gold.
Well, and how bearish are we getting if things like comm services and discretionary don't even get to their 50-day? For as much as we lament about Apple, JP Morgan going out to brand new all-time highs, how bearish can that be if financials are holding up well? I mean, banks in general holding up well. Really hard with that type of characteristic to get overly bearish this market. And now you have a potential breath reset on your hands.
After I don't know, just a 6% decline.
Right. And a lot of top calling, which could still happen. I'm not here to say that the S&P has to make new highs, or that the Russell's even close to making new highs, Russell 2000.
Yeah, well, Russell's got, you just mentioned banks. Industrials have been good, but that healthcare sliver.
Well, and another orange flag would be tech underperforming.
Yeah. Which is going to be a headwind, right? Rotating. I mean, we've talked about that. So I look at an XLK versus S&P chart. We talk about it. We talk about it internally.
Mm-hmm.
It's not, we haven't, now we do own some semiconductors.
Right.
Don't own any broad tech. So that means that I'm clearly ready to go value over growth.
Well, and that's what was going to be my next question to you is like, you look at something like pure growth versus pure value, like an RPG versus RPV, or even a S&P growth versus S&P value. So SPY-G versus SPY-V.
Still growth, very strong.
So what's going on there? If tech is underperforming, and I mean, most tech is considered growth.
Yes, it is.
So what's the deal? How can that be?
Small cap tech is terrible. I mean, small cap tech versus IWM, PSCT versus IWM. It's not a good year and a half into underperformance.
Well, and I think what's interesting are the things that are contributing the most to RPG outperforming are things like VST, a utility.
No, VST.
You got some aerospace, you got some airlines. It surprises me to see United Airlines as a growth company. You got Delta, you got Arista Networks, Uber,
yeah.
Some cruise lines. So it's not your typical, yes, tech is growth, but it's the other growth stocks that are not tech that are carrying the water.
Airlines have been hot.
Mm-hmm.
Cruise lines have been hot. The travel, I think it's Kevin has discretionary workbook, right?
Yes.
And he had that yesterday.
Mm-hmm.
So yeah, your retail, it's just been a pretty 2024 retail. There's the apparel stuff. Yeah, cruise ETF, UZ. It's a strong, absolute. I mean, we had a breakout in late October. Election just helped. Also, an area that never filled its election gap, which I think sets it apart.
Oh, yeah, stronger. You're just saying strength during that time frame. And what was that again? Oh, cruise lines.
Yeah. So one of those areas that had been strong over the last month, 4 or 5 weeks. Dave talked about a lot of these areas, including broad indices, going back, filling their November 6th election gaps. And yet those areas that didn't, I think I'm willing to bet if we made a list of them today and then came back in December, I'm willing to bet majority of those would be outperformers over the next 11 and a half months.
Yeah, I think that's fair. I think that's definitely fair. And so the uptrend is still intact at this point and will be until we close below important levels, regardless of the naysayers, the narratives, the people with 1 foot in, 1 foot out. Time will tell. I guess at this time, I want to highlight the supporter of this podcast, which is the Adaptive Select ETF listed on NYSE under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com, calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. So what else, Ian? What else we want to highlight? We touched base on energy being the strongest sector to start the year. What are we seeing out of some of the energy commodities like crude?
Energy, materials, industrials. Yeah, your top performers through the first 17 days. Commodities, I think, are pretty. If you take a GCC ETF, GCC, it paid out a big dividend back in 2022. So I'd say adjust that. I think it looks, GCC breaking out to new highs. Crude is not breaking. I mean, it's been on a nice run, but GCC's held up pretty well.
Yeah, considering a strong Dow.
Yeah. And so you break it down to the individual commodity level. Cocoa, which really never fell off. Most of this stuff has been pretty good. Orange juice, a lot of your winners from 2024 have stayed strong. Corn has been very strong the last quarter of last year and into this year. Like corn's up to over 1 year highs. So again, you go to the grocery store this weekend, your cobs are a little more expensive. Don't be surprised. And other things have not. Nat gas has been a big winner in 2024. We went from $1.60 we're up to over $4 now, close to $4. But soybeans, pretty weak.
Well, you better get your steak now.
Get your steak. Yeah. Cattle continues to be very strong. Could be paying for your cattle, for your steaks in gold. Maybe you could offset a little bit of it if your butcher takes gold bars.
Yeah.
Coffee's been very strong. Cotton, cheap. Buy your t-shirts. So mixed, but overall, up. Definitely up. Do I want to own commodities over stocks? Some of them I would. Like, do I want to own GCC over stocks? I'm not quite there yet. But, we're getting up there to where...
Well, aren't you thankful that you have a process for that?
Yeah, I don't have to sit here and guess at what some big macro thesis about what I think is going to happen to commodity prices.
Yeah, you just pull up a GCC S&P chart. Step one, right? Still stocks in favor. If you're using the S&P, then start digging.
That's all there is to it.
Yeah, don't need to overcomplicate it. And I do find it interesting too. when we do look at stocks and we look at something like the Russell 2000, and I know that Marlin Capital out here highlighted that small cap positioning is the lowest we've seen since basically 2020. I mean, it's let's call it 15-year lows in small cap positioning. There's a reason for that. I mean, small caps have been meandering and not getting out of the basement.
They just never really, they put it together for a month or two, sometimes a quarter or two, but.
Well, you know what cap level is typically ignored? That's really showing some positive signs is mid caps.
Mid caps. And I ignore them. I'm guilty of that, but they do.
They're at a really,
you got to be in mid caps over small caps.
And they're at a really important area of polarity versus the S&P, going back, since 2004. So we're talking about 20 years. We haven't seen mid caps at this level since then. So it'll be interesting to see if the minor leaguers, if the farm system is strong, if mid caps, if we're going to get some more mid caps that show up in the S&P 500 in the next year or two, will be interesting to watch. So overall, I mean, you have strong crypto for the most part, and I'm talking about your Bitcoin and even Ripple moving higher. You have gold strong while the dollar's been strong. That's notable. And you have all sorts of sectors reclaiming their 50-day after what appears to be a reset and breath. Again, you're not going to check all the boxes, right? We mentioned the red flag of these other areas have to carry if Apple's going to struggle. That's why we use charts. Anything else you want to highlight for our listeners?
No, early in the year, I think we'll have a lot more confirming information in 2 weeks, the end of the month. Like you said, so goes January. Typically goes the year. Not saying it happens in a straight line, but the winners from January typically come December end up being pretty near the high of the list as far as performers. And that could be to the downside too. Not done until you get to new highs on the indices, and those can always fail too. At some point there will be an all-time high that fails and leads us into a bear market. Very, very little evidence, as we saw in most drawdowns in 2024, very little evidence that, quote unquote, this one is going to be it. So,
right. So the trends continue to trend. Hard to complain with that. Obviously, we're aware of things to look for. As always, you're never going to check all the boxes, but definitely notable that across many different measurements that we filled the election gap. And price responded hard there and moved higher. And as Ian said, if we get a positive January, that typically, it's not a prediction that 2025 is positive, but it makes sense, right? If you score first in a game, or if you win the first quarter of a football game, many times you end up winning the game. The odds are in your favor. So appreciate it, Ian, for being on here with me again. As always, a great job. And I look forward to what 2025 brings. I know we have some big plans here at Client First and Adaptive. And so I'm excited for this year, and we appreciate everybody listening. Hope you guys enjoyed this episode. And if you did, please share with your friends, give us a high ranking on your favorite podcast platform of choice. And we will see you next week.
Have a great weekend, everyone.